see everything, and they treat them all the same. They don't. See all six.
And I told him, tough. There we go.
Start wearing my sunglasses.
We good? Okay. Well, good morning, everyone. It is 10 a.m. and with that, I'll call the July 11th, 2024 meeting of the Oklahoma City Employee Retirement System to order. Item number 2 on our agenda this morning is to approve the minutes of the meeting of June 13th, 2024. We have a motion and a second. Please record your vote.
Trustee Thurman, how do you wish to vote?
Aye. Item is approved. Item number 3 is a presentation from one of our investment managers, Brandywine. Jason, you want to lead us off real quick?
Good morning.
Good morning.
Everyone. So this morning, as we continue to just have managers in to give updates, we have Brandywine, which is a global bond manager. You have 25% target to fixed income in your portfolio, which just increased from 20 to 25%, so we're a little underweight there now. We're intending it to be 15% of the 15 of 25, so about 70% of the total to be in core and core plus strategies, and then diversified with more unconstrained bond strategy, and then global bonds to be a diversifying piece that introduces other interest rate cycles and other markets, as well as currency. Performance can be lumpy, and Greg will talk about that as we look at it right now. It looks a bit challenged. If we went back a quarter, you're seeing what the benefits of that diversification is. With that, I'll hand it off to Greg.
Thanks, Jason. So, yeah, I'm Greg Zavoyna with Brandywine. As far as an update, I'll give you a quick update on the firm, and then we'll mostly talk about global bonds and sort of where we're positioned. It's interesting, I mean, just coming in today, we wake up today and you see that all the news is inflation came in a little bit lower, so the markets are rallying, in this case, in our favor. So if you just turn to the first page there. So at the end of, this is as of end of May, but we manage about $64 billion in assets. About $46 billion of that is in fixed income. So we're primarily, a fixed income shop. And again, most of that, I'd say 22 billion or so is in global bonds. So we're primarily a global bond manager. If you turn to the next page. So team, no changes to the team itself. As far as the portfolio management team, the only piece that I would speak to is at the top in the investment strategy committee. There's Francis Scotland is indicated there, and right next to him is Paul Milcharski. Paul joined us about 18 months ago, actually beginning of 2023. The idea was that he would work directly with Francis, and then ultimately Francis would step away. Well, Francis retired on June 30th. So Paul's actually embedded with the team in Philadelphia. So he actually runs all of our global macro sort of studies that we do, and actually contributes to how we approach our global bond portfolio. So so this next piece is just what we do. So Jason said we invest in global bonds. So we invest primarily in the sovereign bonds and currencies of countries around the world, opportunistically investing in credit when it becomes cheap. So we're a value manager. So our sort of home base is sovereign bonds, and when we see the opportunity to invest in something, and I'll talk a little bit to mortgage-backed securities, but then you'll see corporates, and even to a lesser degree, some high yield when the opportunity presents itself. But again, we're a value manager, so we're not going to necessarily invest in things that we feel don't offer value at the time. So if you go to the next page, and this is performance, but what I wanted to do is, and we'll certainly talk the performance of the portfolio, but I wanted to sort of just give you an idea of the global, the landscape for global bonds over the last 10 years or so. So really there's been two headwinds for global bonds, dollar strength. So the dollar has been sort of rising. So this is what we consider dollar strength for the since 2011. And that's sort of a very long period of time. Historically, since 1980, there's been two other periods of time where the dollar was strong and rising. That was from 1980 to 85, and then again from 95 to 2002. So this is sort of an extended, much more extended dollar strength market, and that's historically been strong headwinds for global investors. So we think this one's certainly a little bit long in the tooth, and it certainly was exacerbated by the current fiscal policy, coming out of COVID. So, and we're starting to see that crack now, and that certainly would be a tailwind for bonds. The other piece of that is that over the last 10 years, and you've seen this particularly in 2021, there was about $17 trillion around the world that were invested in global bonds that were negative yielding. We've sort of gotten through that, and we've actually seen the return to more historically normal yields. I mean, you saw the U.S. 10-year was under 1%, and it got as high as 5%, and it's actually settled back down here to about 4.20. But because of that, with that inverse relationship, as yields have risen over the last few years, it's an inverse. The pricing, the valuations of bonds has come down. So that's sort of just an idea. And one other piece I wanted to talk to, as in the dollar strength era, global bonds just really have basically returned a whole lot of nothing. Even in that period of time, actually, the U.S. aggregate, so U.S. bonds haven't particularly done well. If you look back the previous 10 years, the aughts, as I guess you would say, 2000 to 2010, was a period of weak dollar performance, and the global bonds actually returned about 7% annualized. We actually well outperformed it, about 11% annualized, and that outperformed the U.S. Ag, was returning about 6% over that decade. So just to give you some background, there are times when global bonds actually do perform well, but with these headwinds we've been facing over the last 10 years, it's been a difficult ride for us. So if we just specifically talk to your portfolio, and I gave you actually a handout just to give you an idea of sort of the gyrations we've seen over the last 10 years. While the overall performance hasn't been that strong, the portfolio's actually outperformed in the 10 calendar years that we have since inception. 8 of the 10 years we've actually outperformed our index. And interestingly enough, 6 out of those 10 years we actually outperformed the U.S. Ag. So by adding global bonds, it actually, historically has been additive to a U.S.-based investor. When we look to your portfolio in particular, and the performance that I'll talk to on the next page to specifically get into the portfolio itself, we'll talk to sort of the 1-year period. But this year has been a little bit of a struggle, as though coming off last year, I mean, you saw returns in the fourth quarter of over 12% in the portfolio. So naturally, I think you saw in in October, the yields sort of hit high of about 5% by the end of the year for the U.S. 10-year. By the end of the year, they were 3.8. So, I mean, that was a very strong tailwind to the portfolio, and they've come back up since then. So there's been a lot of gyrations. Our feeling is that they'll probably settle in here a little bit. I mean, our expectations are the value of the U.S. the 10-year is about 4% or so. So it's slightly undervalued at this time, but our expectations are that you'll continue to see the rates on the 10-year come in a little bit. If you turn to the next page, and again, I'm going to just talk to this just so you have an idea of performance over the last year. So actually the bonds, if you look at the one piece where the bond market, while we trail both our bonds and currency, the bonds actually did all right in that there was a positive return. Where we struggled is, so our investments in in the U.S. market. We have a little bit more weighting in the U.S. market, and we have a little bit more duration. So we have a little bit more sensitivity to interest rates. So we have longer dated securities relative to the index, which has shorter dated securities. And we all know that, you know, with the flattening and or inverted yield curve, that a lot of times cash is actually earning more than you see in some longer dated. But what you have with the longer dated securities is that you have the ability to actually have some price appreciation as the yields come in. You should see some capital appreciation, and that's our expectations. So you typically have your bonds and you have your currencies. Dollar strength over the last year. There's really one, our yen position. The yen has you know, been a tough position to hold over the past year. It really, the Bank of Japan, their expectations are, our expectations are that they're going to step in and actually make some adjustments, but they really haven't done that. So our yen position, you know, has actually been a detractor. There's some of the other positions. A lot of our sort of Central American, South American currency positions have actually added in value over the last year. So, you know, with that, if we just sort of go to the next page and then so kind of give it where we're sitting, you know, at this time. And this is a lot of information, but really I'll just talk to the portfolio. So the portfolio itself, if you look at this chart, and on the right-hand side, you'll see that in the total line down the bottom, 8.7 years of duration, relative to the line next to it, that's the index at about 7. So we have a greater exposure to duration in the portfolio, and that's because our expectations are that rates at this point have probably topped for the cycle, and they'll begin to come down. The important piece here overall is that the majority of that, about 6.7 years, is in developed markets. Most of that is in the United States, and it's actually split between U.S. Treasuries. And in fact, we have a pretty good, and I talked about this a little bit before, an allocation to mortgage-backed securities, agency mortgage-backed securities, and that's an opportunistic trade. We've been fortunate. It's what we would consider to be a Treasury plus trade. You're actually getting a little bit more than you would get in a Treasury, but because of the unique situation, there's a lot of people holding their 3% mortgages, and with mortgages at 7.5%, there's not a whole lot of prepay risk there. I don't think a whole lot of people are going to be backing out of their current mortgages to move, and well, that alone is causing a whole nother problem, disruption in the housing, that people just aren't moving. But primarily in the U.S., and we have some exposure in the U.K., and then about 2 years would be a little bit of a exposure, what we would consider to be emerging markets or developing markets. The next page, I won't talk to the left-hand side. The right-hand side is sort of our currency position. And really, the largest position we have is the U.S. dollar at about 31%. Now, that's underweight the index at 42%. What you need to know about the index is that, you know, the makeup of the index, 42% is high because the U.S. is a large debtor nation. And that's really, you know, what that comes down to. So typically, we don't like to invest in at least the currency of large debtor nations. So you'll see we actually have an underweighting there. We have an underweighting to the euro. We're about equal weighted to the Japanese government bonds, or to the yen, I'm sorry. And then we have a pretty good overexposure to the Australian dollar. But again, the piece here is that we actually have a good bit. Our expectations are the portfolio is positioned defensively. You know, and we'll have some scattering of emerging market currencies, but our expectations are that sort of there is a slowdown going on globally, and you know, we should be the beneficiary of that, you know, going forward. The last piece, and as far as how the portfolio is positioned, if you see the upper left-hand corner, the current yield on the portfolio is 5.67, relative to the index of about 3.6. I mean, if you just go back 3 years, the yield on on our portfolio was like about 3.5, but the yield on the just global bonds in general were about 50 basis points. I mean, there's a lot of that, as I said, with Europe, with a lot of their negative yielding. So we've seen a good rise. As I say, so, you know, as I say, fixed income is providing income, at this point. So going forward, it's a good starting point. A portfolio of yielding you 5.5% to 6% is a good point. The only other piece I'll talk to in the right is that it's a overall average weighted quality of the portfolio is AA. So it's a high quality portfolio, again, primarily in developed markets. With a yield of 5 to 6%, I think, going forward, global bonds should be quite additive to the portfolio. Now, the wild card being the U.S. dollar, where does that go? And then there's a lot of elections going on around the world. Primarily a really big one coming up in November, and that's probably the biggest wild card as to where the portfolio will be positioned. I mean, we're not necessarily going to take sides either way because you just don't know. So it'll be pretty neutrally positioned going forward, as far as the positioning of the portfolio. The last piece I'll touch on is the next page, and I have lots of charts, but I won't speak to those. Sorry, the next page. And just to give you an idea, I mean, the global economy remains steady, though its growth in the U.S. is sort of now at trend growth, about 2% or so. I mean, coming off of 4. So that's our expectations. What drives the U.S. dollar strength? At least historically, there's two things. There's interest rate differentials. So the U.S. yields a little bit more than other countries, or at least in the developed market. So people want to invest in things that yield a little bit more. And the other piece is sort of the growth. I mean, so the U.S., people talk about the U.S., exceptionalism. So there's been growth in the United States, so people want to invest where it's a growing market. I think that is going to start changing. I mean, overall, as I said, with this fiscal impulse that we've had over the last couple of years, that's rolling over this year. So the money that's coming out of the government won't be there to support some of the economic growth. So we should begin to see some countries around the world actually take over a little bit more in a relative sense. By no means is there going to be strong, global growth, but there should be other pockets around the world that we can invest in that are going to be growing more so than the United States. So with that, I will open it up to questions. There really isn't any. I mean, there's charts in here if anybody has any questions, but there really isn't a couple. Actually, I will give you one, because this is an interesting piece, because people wonder what happens with when they cut interest rates. If you turn to page 20, so just a few above that. There you go. So this is actually, so treasuries tend to perform well after the pivot. So the question, where our expectations now is it'll be a softish landing. I mean, where we're thinking it's a soft, but 6 months ago people were saying it was going to be a hard landing, on that. So we kind of came up with this chart, and really, it's proven that it really didn't matter. It's the pivot that matters. I mean, in some cases, a hard landing, soft landing, sort of no landing. So many months after, rates have really come in, so bonds have actually performed well in all of those scenarios. So the key here is the pivot, and when do we think they're going to pivot? Well, given today's sort of information that came out with inflation sort of coming in a little bit lower, I think it allows maybe the Fed to take their eyes off of looking at inflation and focus more on jobs. Jobs actually, unemployment rate ticked up. So the market now looking for a quarter rate cut in September, went from 73%, I think, to 88% now the expectations are. So our expectations are still that it's going to be 2 rate cuts this year, and probably maybe 150.
The 10-year dropped about 10 basis points, I think.
Yeah, so from like 4.3.
What was that impact on your portfolio, just to highlight the...
I mean, with that basis point move, we'll probably see a return of over 1% in just the portfolio today. We've had a strong month so far, but this is only going to be additive. But because our duration is upwards of 9 years, those interest rates, it really makes a huge impact on the portfolio. So yeah, it's pretty amazing how quickly, I mean, it's not a, you know, a core portfolio where the basis points move in basis points. I mean, you can have, you know, 100, 110 basis point move in one day. And you throw in the currency and it could be a really good day. So, but what I'm saying here is that really the key here for this portfolio to start doing well is that for the Fed to begin to pivot, and then for the U.S. dollar to just, you know, to roll over a little bit. And, you know, well, I would think not only will we benefit, but I think any international equity exposure that you have would benefit from the U.S. dollar weakening somewhat too. So, you know, with that.
Anyone have any questions for Joe this morning? All right, I guess everybody.
Thank you.
I guess I understand everything you said. Just,
Yeah, if you have any questions, just let us know.
okay. Thank you.
Thank you. Thanks, Jake. Yep.
Do we need to? Okay. Okay, moving right along. Item number 4 is the consent docket. We can consider that with one motion. Amy did. Okay, there we go. We have a motion and a new second. Please record your vote. Item is approved. Item number 5 is to ratify approvals. We can take that with one motion. I have a motion and a second. Please record your vote. Item is approved. Item 6 is to approve the claims docket. We have a motion and a second. Please record your vote. Item is approved. Item 7 is to approve the following applications for service retirement. We have a motion and a second. Please record your vote. Item is approved. Item 8 is to approve continuation of pension to spouse. We have a motion and a second. Please record your vote. Item is approved. Item 9 is receive report of death, authorize payment of the $5,000 death benefit, and authorize the secretary to make necessary changes to conform on the following. We have a motion and a second. Please record your vote. Item is approved. Item 10 is to approve the following applications of vested rights. We have a motion and a second. Please record your vote. Item is approved. Okay, where am I going here? Item 11 is to receive the investment consultant report. Jason.
Thank you. So you have the ASAP, and I've added a couple of slides that I think are interesting and just talk about performance. As we look at performance of the portfolio, the absolute performance of the total fund is good over the last year. Relative performance, we trail our policy benchmark. a bit. Some of that is, a good portion of that is because a significant portions of the portfolio are being benchmarked against the S&P 500 that aren't large cap. With that said, active management across the board has struggled over the last year. I've got some slides here to highlight why that's happening. But if just on this one, if you look in the upper left, markets continue to be dominated by U.S. large cap stocks. The S&P 500 year to date up 15.3%, and you can see that's really outperforming everything by 2 times. The second best asset class on a year to date basis through the end of June is emerging markets, up 7.5%. Small cap stocks through June only up 1.7%. On a 1 year basis, which isn't on here, similar story, large cap US up almost 30%, small cap up 9%. So large cap's up almost 3 times that of small cap. International has done okay, up 16%, but that's about half of US large cap. In the lower right there, you see performance by sector, and it's pretty telling when we look across all the sectors in the S&P 500, technology and communication services, AI-related sectors, where the Magnificent Seven stocks reside, leading the way, up 13.8 for technology, communication services, up 9.4. If you go down and look at the equal weighted index, those are the S&P equal weight. Those are the same 500 stocks, but weighted equally. So if each one represented the same weight in the index as opposed to being weighted by the market cap, the S&P 500 is negative for the year, negative 2.6%. Go to the next couple slides. This is the original one. Did you have the updated one? Okay. This was really some hard-hitting stuff that we had to show you. Okay. Well, I'll just go over some of these stats because it's pretty eye-opening. Year to date, the 6 companies that have been the primary beneficiaries of AI, Broadcom, Amazon, Meta, Alphabet, Microsoft, and NVIDIA, the year-to-date gains in those stocks is more, just what they've gained in market cap in 2024 so far, is more than the overall market cap of Johnson & Johnson, Exxon, Walmart, Visa, JP Morgan, Eli Lilly, and Berkshire Hathaway, which is pretty astounding. Those are stalwart U.S. companies, long-time companies, but those 6 AI-related stocks, just what they've gained in market cap this year is greater than the market cap of those 7 companies. The gain in those 6 stocks is greater than the overall GDP of Japan by itself, greater than the GDP of Saudi Arabia, Switzerland, and Canada put together. So it's just pretty astounding how those 6 stocks have really led the way. And it's not just in large cap. You don't have this in front of you. I know Mike sent it out yesterday, so take a look at it. It was the updated version of the ASAP with a couple slides. It's impacted small and mid-cap indices as well, while not to the same degree, but there's been high levels of concentration leading the way across markets. Within just at the end of June, the Russell indices, they reconstitute how those indices are constructed one time per year at the end of June. And so the growth indices, they got bigger and fewer names. Value indices got a little bit smaller and less concentrated and more names, both in large cap and small cap. Just to give you some perspective on that, prior to the reconstitution of the Russell 1000 value, the top 10 represented 18%, the top 10 stocks in the value index. After the reconstitution, it represented 17, so a little less concentrated. The growth index, the top 10 stocks, was almost 58%, and after the reconstitution, it's now 62%. So they're more concentrated. I think small cap it's more enlightening. Small cap growth, which your manager, Silvercrest, has had a tough time, up about 1% when the benchmark's up 10. A big part of that is not owning a couple of stocks within the small cap growth index that were no longer small cap. Two stocks, Supermicro and MicroStrategy, both moved from the Russell 2000 and the Russell 2000 growth into the Russell 1000 and the Russell 1000 growth. Supermicro went from about a $2 billion market cap to close to $60 billion. It represented 3.2% of the Russell 2000 growth index. With that coming out, now the largest position in that index is 0.8%. I'm mentioning these things just to highlight how challenging it is for active managers that aren't owning as much of these things to keep up with the index, where the most expensive things just keep getting larger and larger. And most of our active managers are seeking things that either are reasonably priced or have a higher expectation of growth. One last thing on this topic, because this one was pretty surprising. So while we talk about the narrowness in U.S. markets, the MSCI ACWI index, which is a global benchmark of 9,000 stocks, 5 stocks, 4 of which are Magnificent Seven and one other stock, Taiwan Semiconductor, represented over 100% of the return of that index in the second quarter, up 2.4%. Those 5 stocks, the index was up 2.38%. So the other 8,995 stocks actually were down 5 basis points in the quarter. Just an example of how narrow markets have become globally. So I mention all of those things just to highlight the challenge for active managers. As we look at your portfolio overall, the 1-year return up 8.5%, a little over 8% net of fees. We are trailing our policy index for all the reasons we've talked about. And as we look at some of the active managers, there is some dispersion relative to benchmarks. We don't believe we have any managers that are deviating from their approach or style, or that there's concerns. The challenging part of being a long-term investor is sticking with the plan when things are really going well, and sticking with the plan when things aren't going so well. I think right now, things are going well, better than what your required return is by about 100 basis points over the 1-year period, but we're trailing the benchmarks. But understanding what's going on, I think, is important. So I apologize, didn't get that in your material. I think there's a couple of those charts that if you can take a look at them, they're pretty eye-opening. But with that, unless there's questions, I will. Great.
I was just going to ask you, where are we on, can we go to the one that talks about where we are on our weights? Mm-hmm. Because to me, if we got to stick to our discipline, but then if we're overweight,
Great.
Is it a time to be disciplined and harvest and rebalance and all that stuff?
The long-short equity, a significant portion of that $49 million will be coming back this month. We've put in a full redemption, and that's really the overweight in equity. That's 5.6%, and the target is 0. The redemptions were effective June 30. That cash will be coming back in the month of July, probably the latter part of next week. It won't be 100% of that, And I had some numbers, and Matt, I'll get with you, but it's over 50% of that is going to be coming back this month. We'll look first for your cash needs, to deploy it for cash needs, and then we will rebalance it into fixed income. And then that will continue to be trickling back over the coming months. Thank you for reminding me of that.
Any other questions for Jason? Hearing none, Chair will entertain a motion to accept the monthly investment report. I have a motion and a second. Please record your vote. Item is approved. Okay, prior to moving to item 12, I need to inform the board that we received notice from Ken that he is going to be resigning his seat. And I've contacted Mayor Holt's office and asked them to begin the process to find a new trustee. So that's where we're at. But as such, item 12, we need to elect a vice chair for the remaining term of July 11th through December 31st, 2024. And I would like to nominate Brent Bryant to fill that role. What do I, okay. Well, anyway, we have a motion and a second to have Brent fill that role through the end of the calendar year. So please record your vote. We're fixing it. There we go. Okay. Now we're ready. Record your vote, please. Item is approved. Thank you for volunteering, Brent. You're welcome. Item number 13 on our agenda this morning is comments from board, staff, and citizens. Okay. Hearing none, we are adjourned at 10:36. Thank you, everyone.